Build your dreams, live rich, and leave
You've
rich.
seen it happen. The news alert flashes on your phone. A well-known company on Dalal Street has just announced a stock split, or maybe a bonus issue. Suddenly, the forums, the chat groups, they just light up. Everyone's talking about free shares. There's this mad rush to buy. But let me ask you, is it really free money? Today, we're going to cut through all of that noise, all of that hype, and find out the brutal, honest truth. So here's our game plan. We're going to start by shattering the big illusion, this myth of instant wealth. Then I'll give you a super simple analogy involving pizza that will make everything click. After that, we'll dive deep into the actual mechanics of both splits and bonuses. Then comes the most important part, the brutal math that happens while you sleep. And finally, we'll uncover the real reason why you should still care, the hidden way this can actually generate wealth for you in the long run. All right, so let's tackle this head on. A company announces they're giving you free shares. It's so tempting, isn't it? The immediate thought for so many people is, I need to get in now. My investment is about to double. But you know what? This is probably one of the most common and frankly most expensive myths that trips up new investors. Let's make this really personal. Imagine your portfolio is worth 1 lakh rupees. You own shares in a company, and they announce you're getting double the number of shares you currently hold. So you go to sleep, and when you wake up the next morning, is your portfolio now worth 2 lakh rupees? The short answer, it's a hard, definite no. And we're about to find out exactly why. You know, to really understand what's going on here, let's just forget about stocks and finance for a minute. Let's talk about something much, much simpler. Let's talk about pizza. Seriously, this one simple analogy is going to be our guide for the rest of this entire explainer. This right here, this is the whole story. A stock split, on the left, is like a chef taking your one giant slice of pizza and just cutting it into smaller, easier-to-eat pieces. You now have more slices, for sure, but did you get more pizza? No. The total amount of food is exactly the same. Now, a stock bonus, that feels different. That's like the chef taking money from the restaurant's profits and baking you a completely free dessert. But as we're about to see, the stock market has a special way of making sure that even this free dessert doesn't instantly make your wallet any fatter. Okay, let's get into the details. First up, this stock split, or as we're calling it, the act of slicing that giant pizza. What is it really? And why in the world would a company even bother doing it? Now that sounds a bit technical, but the most important words there are that the face value is reduced. Think of face value as the original nominal price printed on an old paper share certificate, maybe 10 rupees. When a share splits into 5, each of those new, smaller shares now has a face value of just 2 rupees. The company's total share capital, which is tied to this value, stays exactly the same. It's just accounting. So why do it? Well, this slide shows you the perfect reason why. Have you ever looked at the share price for MRF tires? It's massive, over 1 lakh rupees for a single share. How can the average person, a student, a small investor, possibly afford to buy even one? They can't. And that's a problem for the company because it hurts something called liquidity, the ease of buying and selling. A stock split is the perfect tool to solve that exact problem. Let's just run the numbers. It makes it so clear. Before the split, you've got 100 shares. The market price is 1,000 rupees each. Your total investment, 1 lakh. Simple. Now, after a 1-to-5 split happens, poof, your share count jumps to 500. Feels good, right? But look very closely at the market price. It gets automatically adjusted down to about 200 rupees per share. So what's 500 shares times 200 rupees? It's still exactly 1 lakh. The value in your account hasn't changed one bit. All right, now for the bonus issue. This one feels more like a genuine reward, doesn't it? It's the chef coming to your table with that free dessert. So how does this actually work? And what makes it different from a split? The magic words here are out of the company's free reserves and accumulated profits. What this means is that a company has been so successful, it's sitting on a big pile of its own saved up profits. Instead of just giving you cash, it converts those profits into brand new shares and then gifts them to you for free as a thank you for being a shareholder. And think about what that signals to the world. It is a massive vote of confidence. A company can only do this if it has real, substantial profits just sitting there in its bank account, in its reserves. It's like the company is shouting from the rooftops, hey, we are doing incredibly well. Business is great. It's a huge signal of financial strength. So let's look at the math for a bonus. In a 1-for-1 bonus, your share count doubles. 100 becomes 200. Now here's the key difference from a split. The face value stays the same, but Even though the mechanics are different, the market price still adjusts. It gets cut perfectly in half, from 2,000 rupees down to 1,000. And the result, well, you already know. Your total investment value remains exactly the same. Okay, I need you to listen very closely to this next part. This is, without a doubt, the most important takeaway of this entire explainer. This is the moment where the myth of free money gets completely shattered by simple, cold, unavoidable mathematics. So let's set the stage. It's the night before the split or the bonus is scheduled to happen. You open your app, you look at your portfolio before you go to bed. And this is what it looks like. You own 100 shares. The market price is 2,000 rupees a share. That gives you a total investment value of 2 lakh rupees. Pretty straightforward. Now, this is the crucial part. While you are sleeping, something happens. But it's not the market reacting, it's not traders panicking or getting excited. No. The stock exchange itself, the system, performs an automatic, mandatory calculation. It mathematically adjusts the share price to reflect the new number of shares that now exist. And this is what you wake up to. You now have 200 shares. And that feels great. But look at the price. It has been perfectly surgically halved to 1,000 rupees. Your total portfolio value is still down to the very last rupee, 2 lakh. No magic, just math. So let me make this crystal clear. Whether it's a split or a bonus, the immediate impact on your net worth is zero. Nothing. The market is designed to ensure that the total value of what you own remains absolutely identical. There are no free lunches on Dalal Street. Period. All right, so you're probably thinking, okay, Krish, I get it. I don't get richer overnight, so why should I even care? Why is this a big deal at all? That's a great question, because the real value isn't in the event itself. It's in the opportunities it creates for the future. This is what I call the hidden wealth generator. So here's where the smart, long-term thinking comes in. First, the lower price brings in more people. That's increased liquidity, more buyers and sellers. That's good. Second, there's a powerful psychological effect. A stock just feels cheaper at 1,000 rupees than it does at 2,000, even if the value is the same. It attracts new buyers. But the third reason, this one is my favorite. This is the magic of future dividends. This is where you can see a real, tangible benefit down the line. Just imagine the company decides to pay a dividend of 10 rupees per share. Before the split or bonus, your 100 shares would have earned you 1,000 rupees in cash. Not bad. But now, with your 200 shares, that same 10 rupees per share means you receive 2,000 rupees in cash. Your actual cash-in-hand income from this investment has literally doubled, even though the total value didn't change on day one. So let's end with this thought. We've busted the myth of instant riches. But in its place, we found a much more subtle and, frankly, a much more powerful truth. The real win isn't the split or the bonus itself. It's everything that comes after. The increased interest, the better liquidity, and most importantly, the potential for significantly higher cash income down the road. It's not about getting rich today. It's about setting the stage to build real wealth tomorrow.